Hello and welcome to our webcast. Moss Adams is pleased that you joined us for today's webcast, Spring 2024 Tax Update for Not-for-Profit Organizations. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I'd like to introduce today's presenters, Emina Cresswell and Mike Lumsden, both senior managers here at Moss Adams. Their bios and contact information are located in your console if you would like more information. Now, I would like to turn the floor over to Mike to get the presentation started. Mike?
Thanks, Danielle, and welcome everyone to the Moss Adams Spring 2024 Not-for-Profit Tax Update. Again, my name is Mike Lumsden. I'm a tax senior manager in our San Francisco office, and I'll pass it to Emina to do her brief intro.
Thanks, Mike, and I'm Emina Cresswell, tax senior manager out of our Spokane office. I lead our Washington State tax-exempt practice and help organizations with a variety of locations, both within and outside the U.S. Back to you, Mike.
All right, great. I just wanted to briefly chat about our agenda. It's a bit of a packed hour that we'll have here. First and foremost, we're going to go through some regulatory provisions affecting tax-exempt organizations. Next, we'll chat about a hodgepodge of other updates. And last, we will hit some election year update and reminders, just given that 2024 is an election year and there are some rules and regulations that nonprofit entities do need to follow. So first and foremost, we'll start with the regulatory provisions affecting tax-exempt organizations. First, I wanted to chat about the Inflation Reduction Act. On August 16, 2022, President Biden signed into law the Inflation Reduction Act. While there's a lot to unpack from this bill, our focus here is on the clean energy component, which aims to invest in domestic energy production and manufacturing, and also reduce carbon emissions by roughly 40% by 2030. Now, previously, nonprofit entities, they had limited options for taking advantage of the various clean energy tax credits. Prior to the Inflation Reduction Act, these tax credits were offered as a non-refundable credit, meaning if you had no income tax liability, meaning unrelated business income for nonprofits, you couldn't take advantage of these tax credits. Rather, in general, a nonprofit would be faced with entering some type of third-party agreement, a solar lease or power purchase agreement, or similar financing options where only a third party could use the project's solar tax credits on behalf of the nonprofit. and the nonprofit would essentially negotiate price based off the credit claimed by the third party. Well, all that is changing for tax years beginning on or after December 31st, 2022. So this is all just brand new right now. And this is solely available to nonprofits and governmental entities. The IRS is providing that these various clean energy credits can be claimed as a refundable tax credit, commonly referred to as direct pay, which would be reported on a Form 990-T, which is the income tax paying form nonprofits and governmental entities file if they have UBI. Again, even if a nonprofit or a governmental entity has no UBI to declare, you could still file a zero Form 990-T reflecting just the refundable tax credit and get a refund from the IRS for the credit calculated. There are a few items I wanted to highlight here in regards to the credit. First, the credit can only be claimed for the year placed in service. And that's for the clean energy project placed in service. So if there's a solar panel project underway at a nonprofit where construction begins in 2022 but ends in 2023, the credit would need to be claimed on the 2023 Form 990-T. That, of course, presuming the nonprofit is a calendar year entity. Second, the credit cannot be claimed on an amended 990-T or a late filed Form 990-T. So using that previous example, if there was a clean energy project placed in service in the 2023 calendar year and the nonprofit is a calendar year-end entity, if the Form 990-T was extended, you would have until November 15th, 2024 to file the 990-T and claim the credit. If the 990-T was not extended, then in theory, you would have had until May 15th, 2024 to file the 990-T and claim the credit. Sadly, under the proposed regulations, there doesn't appear to be a mechanism for nonprofits or governmental entities to request a refund later. So it's super crucial that these clean energy projects are being tracked, especially when they're placed in service. Next, we'll go into what actually qualifies as clean energy technology eligible for these tax credits. I've included a list of some of the more popular ones here on the slide. These include solar energy panels, alternative energy vehicles and refueling properties. So think your electric vehicles and EV chargers, but only in certain instances for the latter, geothermal heat pumps, energy storage technology, and combined heat and power systems. All right, now what I wanted to do is highlight three of the more popular credits available as a part of the Inflation Reduction Act and how much a nonprofit or governmental organization could benefit. Before I highlight those credits, I will caveat that there are two components to many of these credits, primarily those which produce some type of renewable energy. Firstly, there's an investment tax credit, which is a credit calculated based off a percentage of the project's cost basis. And secondly, there's a production tax credit, which is calculated based off the electricity or energy generated by renewable resources. Now, in general, you can't claim both the investment tax credit and production tax credit on the same property, but just know that there are two options available. What we'll be doing here is highlighting just the investment tax credit as it pertains to three of the more popular clean energy projects, as these seem to be the credit most nonprofits and governmental entities are taking advantage of. First up on the list is IRC Section 48, which provides for an energy credit. The most common vehicle for these is solar panels. Under IRC Section 48, nonprofits could receive a federal energy credit as high as 50% of the cost basis of the property. The base of the credit is 30%, but there are add-ons of 10% each for domestic content production, and if the project is placed in service in what's called an energy community. And this can be looked up by running a query of the address where the project is placed in service on the U.S. Department of Energy's website. Currently, what we're seeing in practice is that most projects are having trouble meeting this domestic content production hurdle. The U.S. simply hasn't ramped up production on these solar energy projects high enough to meet demand. So we haven't seen too many organizations be able to take advantage of this additional 10% bonus. Of note here is that it's crucial that these solar energy projects be under 1 megawatt in size, which from what I read is about 6 to 8 acres of solar panels, so it's pretty big. Otherwise, if there are more than 1 megawatt, they must meet labor requirements issued by the Treasury Department, and there's a long list of these, which I won't go into detail. However, again, if the project is under 1 megawatt in size, you don't have to worry about that. So let's highlight a simple example here. Let's say a solar panel project was installed by a nonprofit for a cost basis of $500,000 and was under 1 megawatt in size, presuming the domestic content production hurdle can't be met, and presuming the project isn't in an energy community, the nonprofit would be looking at a $150,000 refundable tax credit, and it can claim that on the Form 990T, and that's 30% of the project cost basis. If the project was placed in service in an energy community, we'd be looking at a $200,000 refundable tax credit, so 40% of the cost basis. Another popular clean energy credit we're seeing is Section 45W, and that's the credit for commercial clean vehicles. So think of your electric cars, buses, vans, et cetera. This would be great for organizations who perhaps have a fleet of vehicles and are looking at replacing some or all of those. With the Inflation Reduction Act, there would be a maximum income tax credit of $7,500 per vehicle, or $40,000 if the gross vehicle weight is 14,000 pounds or greater. The last one I wanted to highlight is IRC Section 30C. This is a credit for installing alternative fuel stations or EV chargers. Sadly, this credit isn't available to all projects. Rather, it's only available for projects placed in census tracts that qualify as low-income communities or census tracts designated as non-urban areas, and that's defined by the Census Bureau right there. If it's determined that the project is in one of those areas, the credit would be 6% of the cost plus another 30% bonus credit if wage and apprenticeship requirements are met. And again, there's a long list of those. There's a cap of $100,000 per item on this one, though. All right. The last item I wanted to highlight on clean energy credits here, which nonprofits and advisors need to be made aware of, is that the clean energy project must be registered. What this means is that there are steps to take well before the Form 990T is to be filed. And remember, the Form 990T can't be amended or filed late, so you want to make sure you complete the step at least 120 days prior to your Form 990T being due. So again, using an example of a 990T due on or before November 15, 2024, this registration process should be started before July 15, 2024. So it's coming up in the next month and a half. What needs to happen is nonprofits must engage in a pre-filing registration process to make a direct pay election on its Form 990T. The IRS launched this process to really help decrease improper fraudulent energy credit claims, and this should be completed by the organization or its advisor online through the IRS website. And the web address, it's far too long to spell out here on the slide, but if you do a simple Google search, it should pop up. What happens thereafter is that within that 120 days, the organization will obtain a registration number for the clean energy project, which would be then reported on the 990T for the year in which the tax credit is claimed. To finish off on clean energy credits here, there are a lot of opportunities, especially for nonprofits who own the buildings they operate out of. You know, if you're just have a leasehold, it might be tough to install these clean energy projects, especially solar panels. This can be kind of crucial for budgeting, though, as projects which might have not been economically viable might now be. And as a plus, it could advance clean energy initiatives, which is inherently mission-related, I know, for a lot of tax-exempt organizations. And with that, I'm going to pass it to Danielle for our first polling question.
Thank you, Mike. Here we are at our first poll question. Will you be taking any IRA tax credits? A, yes. B, no. C, not applicable.
Yeah, we've seen a lot of organizations we're finding they either already have these projects in place, especially if they have buildings that they own. What I would caveat, though, is if you've had one that's in process, take a look to see if this credit is already being claimed by maybe some third party. We really shouldn't be double dipping on the credit, and that's why there's that registration process.
And here are the results.
All right. It looks like some are yes, the majority are no. I'm assuming maybe a lot of these organizations might not own their buildings But certainly, it's something to be made aware of just because there's a lot to unpack there. All right. Right, moving on and shifting away from clean energy credits, the next big hot topic we've seen in the nonprofit sector is donor advice funds. For those unfamiliar with DAFs, it's a charitable giving vehicle that allows a donor to make contributions to a public charity, receive a tax deduction, and then recommend grants from the fund over time. Essentially, the donor surrenders ownership of their contributions but retain advisory privileges over how they are invested and distributed. Congress and the IRS, they've had their eye on donor advice funds in recent years, primarily concerned that donors are receiving an upfront charitable tax deduction without the requirement to distribute those funds out of the sponsoring organization. Essentially, they're worried that DAFs might just be a parking lot, so to speak. The IRS and Treasury is also concerned that donor advice funds are being used to prop up the public support percentages of public charities who are the recipient of distributions from DAFs. Given that for the recipient organization, these funds are deemed to come from the sponsoring organization rather than the underlying donor. You've probably heard a lot of proposed regulations regarding DAFs in recent years, but all of it has been proposed without anything actually placed into law. There were requests for comments back in 2017 regarding potential changes regarding treating grants coming out of a DAF as coming from the underlying donor rather than the sponsoring organization. Also, you probably heard about the Accelerating Charitable Efforts Act in 2021, which proposed a 15-year and 50-year DAF and prescribed distribution timeline requirements and rules on when donors could take a tax deduction. Ultimately, I think what we're going to see is not sweeping one-time legislation like those previously proposed, but rather smaller reforms for DAFs bit by bit. You can see here on the slide that the IRS Priority Guidance Plan for 2023 through 2024, it divided the future DAF rulemaking project into 4 parts. One is regulations regarding DAFs, including excise taxes on sponsoring orgs and fund management for impermissible distributions. 2 is regulations regarding prohibited benefits, including excise taxes on donors, donor advisors, related persons, and fund management. So here, think of donors who use DAFs to pay for tickets to another public charity's fundraising event. Third, regulations regarding donor-advised funds and supporting organizations. And lastly, guidance regarding the public support computation with respect to distributions from donor-advised funds on the ultimate recipient of those funds. Well, we finally got our first bit of proposed regulations regarding these DAFs, but the Treasury has a long way to go in delivering on the 4 items highlighted here on the slide. They released the first installment of the regulations in November 2023, and comments were due back on those in February 2024. As you can see on this slide, these regulations, they were really just primarily definitional, and they didn't really add anything significantly new to the laws and regulations surrounding DAFs, but it did provide some clarification on some items. The proposed regulations, 1, defined what a DAF is, 2, who a donor is, 3, who a donor advisor is, 4, what constitutes advisory privileges, and 5, what would be considered a taxable distribution out of a DAF. What these first batch of proposed regulations failed to address, though, is guidance on the other issues, but we are anticipating maybe future regulations do address these. What it failed to address is private foundations and the use of DAFs. You might be aware that often PFs will distribute amounts out to a donor advice fund to meet their 5% minimum distribution requirement. 2, DAF distributions where the donor advisor receives more than an incidental benefit from the distribution. And again, these would be in instances where the DAF is used to fulfill a personal pledge of the donor or maybe pay for fundraising event tickets for the donor. 3, impacts of the public support calculations for recipient of distributions of the DAFs. And lastly, any potential payout requirements to curtail the perception that DAFs are essentially just parking lots for charitable dollars. All right, moving into some specific definitions that were provided as a part of the November 2023 regulations. Let's start with what a DAF is. And again, nothing super groundbreaking here, but they define that a DAF is a fund or account which, 1, is separately identified by reference to contributions of a donor or donors. Two, which is owned and controlled by a sponsoring organization. The most common example, of course, is community foundations all over the country, but it can include so many more organizations beyond those. And three, at least one donor or donor advisor has or reasonably expects to have advisory privileges with respect to the distributions or investment of amounts held in the DAF or the fund. So again, nothing crazy groundbreaking, but it's still worth noting as there are some nuances in these definitions, which some in Congress and in the DAF space are calling very broad and has the potential to pull in some funds which might not have been thought of DAFs before, but under these definitions could be deemed a DAF. And thus, they would ultimately fall under the DAF rules. All right, under the regulations, there would be a 20% tax on sponsoring organizations for a taxable distribution and a 5% tax on fund managers who knowingly agree to make a taxable distribution, but the latter half would only be for knowingly and willful rule breaking right there. While this isn't new, what's of note in the proposed regulations is that Treasury and the IRS rejected requests to construe the term distribution narrowly and only include gratuitous transfers. Rather, any payment from a DAF other than most investments and reasonable investment and grant-related fees would potentially be subject to and therefore need to comply with the taxable distribution rules. Otherwise, you would have to pay the excise tax. All right. Moving on to some more specific definitions here. In regards to the definition of what would constitute an account which is separately identified, the proposed regulations clarify that this can be achieved if the sponsoring organization maintains a formal record of contributions to the fund relating to the donor or donors. However, in the absence of such a formal record, facts and circumstances would prevail. You would look at whether the donor receives a fund statement from the sponsoring organization reflecting contributions, investment earnings, admin expenses, and distributions from the DAF, whether the fund is named for the donor, if the fund is actually called a DAF in marketing materials, or if the sponsoring organization solicits advice before making distributions. If any of these are met, you might be looking at a donor-advised fund. All right. Next, we'll see that the Treasury goes on to define what a donor is in the proposed regulations. Treasury explains that a donor includes any person or entity that makes a contribution to a fund or account of a sponsoring organization. However, notably, public charities described in 509A1, A2, or A3 and governmental units are not considered donors with respect to a DAF. It should be noted here, though, that this does not extend to 501c3 organizations, which are private foundations. These organizations would still be considered a donor under the proposed regulations. All right. Next, you'll see in the proposed regulations that Treasury defines what a donor advisor is. The most common donor advisors would include the person who is designated as such by the donor, a person who establishes the fund or account and advises as to distributions or investments. Also, I think what's interesting here is a personal investment advisor that provides investment management services with respect to both the DAF and maybe personal non-DAF assets of a donor. However, it should be noted that a donor advisor would not include the investment manager who provides services to the sponsoring organization of the DAF as a whole. So with this, the sponsoring organization can employ investment advisors to invest a pool of DAF assets. However, if a DAF utilizes an investment advisor outside of the sponsoring organization, i.e. someone who isn't employed by the sponsoring organization, then the DAF can't compensate that investment advisor. So that's something that's interesting right there. Another common donor advisor would be a member of an advisory committee. However, there are exceptions if certain requirements are met. These requirements include that the individual is recommended based off an objective criteria, the committee has 3 or more members, and a majority are not recommended by the donor, and that committee is not related to the donor as well. All right. Next, we'll explore what constitutes advisory privileges as defined in the proposed regulations. The proposed regulations offer a facts and circumstances test for determining whether donor has advisory privileges over the fund, regardless of whether they are actually exercised. Under the regulations, advisory privileges are deemed to exist if, one, the sponsoring organization allows the donor or donor advisor to provide non-binding recommendations regarding the distribution or investment of DAF assets. Two, if there's a written agreement stating the donor or donor advisor has such advisory privileges. Three, that there are marketing materials of the sponsoring organization indicating the donor may provide such advice. Or four, the sponsoring organization generally solicits such advice from the donor or donor advisor. It should be noted that privileges from service on an advisory committee would fall under this, and the rules applied to the entire fund, meaning if one donor or donor advisor has advisory privileges, then the fund is a DAF. Further, officers, directors, employees of the sponsoring organizations, they are not considered as having advisory privileges, so you can exempt those folks. All right. Next, you'll see the proposed regulations also define what a distribution from a DAF would be, and further what's called a taxable distribution. For distributions, again, it's really a broad definition here. Essentially, a distribution would be any payment from a DAF other than most investments and reasonable investment and grant-related fees. The definitions go on to further define what would be a taxable distribution versus a non-taxable distribution as well. A taxable distribution, it's again any distribution where the excise taxes we mentioned previously would be incurred, and this would be any distribution from a DAF, one, to a natural person, so individuals, or two, to any other person if the distribution is for any purpose other than charitable purposes, or if the sponsoring organization does not exercise expenditure responsibility. So it's very similar to the private foundation rules. So here, again, distributions to U.S. public charities are okay, but distributions to non-U.S. public charities would be a taxable distribution unless there's an equivalency determination that's made that the recipient is a U.S. public charity equivalent or expenditure responsibility is followed. All right. And with this, I will pass it to Danielle for our second poll question.
Thank you, Mike. Poll question number 2. Will you be impacted by the new DAF rules? A, yes. B, no. C, not applicable.
And I'll highlight here that, I think almost everyone's going to be impacted by these new DAF rules. If you're the recipient of contributions from a donor advised fund, this could impact your public support calculation if you're at another nonprofit. So certainly I think a lot of folks could be impacted by here. And I think these rule changes will be prospective rather than retroactive. So there'll be some time to react to these if and when these proposed rules are made.
All right, everybody, we'll push this forward to the results.
All right. Thanks very much. All right. In our last few items here on DAFs, lastly, the proposed regulations, they elaborate on and expand the statutory exceptions for funds that are excluded from DAF status. These include funds that make grants to a single identified organization, scholarship funds, and these would be funds in which a donor or donor advisor advises grants to individuals for study. The proposed regulations also add a related exception to DAF status for scholarship funds established by a membership 501c4 organization like a Rotary Club. And lastly, disaster relief funds are exempted from the DAF rules. The proposed regulations exclude from the definition these funds where it's essentially just around to provide relief from one or more qualified disasters. All right, moving on a bit, I wanted to touch on the Green Book, which was just released in March 2024. What the Green Book does is it explains various revenue proposals included in President Biden's budget. There are a few items in here which are pertinent to tax-exempt organizations, but both of these proposals have appeared in prior instances of the Green Book, so it's nothing new, but still worth mentioning. And again, these are all just proposals, and nothing is in law just yet on these. The first item in the Green Book pertains to private foundations, and if they would be able to include payments to disqualified persons as a qualified distribution. And with disqualified persons, you're looking at your officers, your directors, your substantial contributors. You might be aware that private foundations can treat various and necessary administrative expenses, such as salaries, as a qualifying distribution for purposes of their 5% payout requirement. Under the proposals, these would now be excluded from counting towards that payout, and you wouldn't be able to include it in that last column of page 1 of the Form 990-PF. The next item in the Green Book also pertains to private foundations and its interplay with donor advised funds. Again, DAFs are a huge hot topic. You might be aware that private foundations often will donate to donor advised funds established by the private foundation to help meet their payout requirement. Under the proposal, though, distributions from private foundations to DAFs would be excluded as a qualifying distribution from for the private foundation unless the DAF expends the funds it receives by the end of the following tax year. This, of course, would call for a lot of additional record keeping for both the sponsoring organization of the DAF and the private foundation to utilize donor advised funds. All right. Lastly, and before I pass it off to Emina, I wanted to take a moment to shine some light on some updates in the tax-exempt hospital sector. Many folks might be aware that the criteria that establishes a hospital's tax-exempt status is coming under scrutiny. There was a bipartisan group of senators asking the IRS to ramp up its compliance and enforcement of the community benefit standard. What these senators did is it sent a letter to the IRS citing examples that maybe showed some nonprofit hospitals might not be fulfilling their required obligation to provide reduced or free care to their vulnerable patients. Currently, there's no bright line standard hospitals are required to adhere to as a part of the community benefit standard. And this is all present on Schedule H, Part 1 of the Form 990 for these tax-exempt hospitals. Rather, evaluating community benefits, it's often more qualitative or narrative in nature rather than quantitative. What Congress is asking Treasury and the IRS to do is to really sharpen its pencils to see if Schedule H can be enhanced in ways to ensure hospitals are providing an adequate level of community benefit. So here, it'll be interesting to see what changes come out of this in future years. But just be aware, if you are a tax-exempt hospital, be sure that you're capturing all expenditures which should be considered a community benefit and report those on Schedule H, Part 1 of the 990. It's really being scrutinized by both Congress and even some in the press, too. All right. And with that, I'm going to pass it on to Emina, who's going to provide some other updates for us.
Great. Thanks, Mike. So with that, we're going to switch gears, talk about, state of the IRS, what's happening, what's in the news, what are they working on, and current trends. So IRS exam resources and investments, what the current challenges are, as they've always been, is just a huge IRS backlog over the last 4 filing seasons. They have hurdles and challenges with external hiring and staff retention, which of course adds more challenges to being able to timely respond to things and being able to help taxpayers out. We've been at conferences and the IRS continues to advertise, we're hiring, please apply. So very interesting to hear that pop up more and more as they're speaking at conferences. But there might be some good news. There's about $60 billion increase in funding for the IRS over the next decade, including a significant increase in IRS enforcement budget, increasing funding for data analytics and strategies to identify noncompliance, and the significant expansion of third-party information reporting requirements. The IRS is also ramping up specialists to assist with complex audits and emerging issues to make up for the stemming decade-long trend of declining audit coverage. And they're also looking at providing new and improved online tools for taxpayers so that they can communicate with the IRS more easily and quickly. Kind of getting with the times right now, is most of the communication is either through mail or fax, and so trying to improve technology to help improve the user experience, the client experience is what they say, to help address issues much faster and hopefully easily, but we'll see. With that, the IRS and the TEGE, Tax-Exempt and Governmental Entities Division, usually issues an accomplishment letter that describes, here's what we've done during the year, here's kind of a summary of what we've seen, and here's the trends. So this one was very interesting in that they looked at 2,529 examinations, and of those closed 2,464. Of those examinations that involved the Form 990 series returns, including the private foundation, so the PF, the 990T, and associated employment and excise tax returns, overall, about 76% of those closed examinations resulted in a tax change. Now, we don't have the details of what that actually was and how much it was, but we do know that a pretty substantial amount of those examinations did result in some changes. And 40% of those examinations were picked up from related examinations as well. So kind of if you get picked for one, there's a chance you might get picked for another component of what would be part of the examination process. And as part of that, the IRS also proposed exempt status revocations for 141 tax-exempt entities because of those examinations. So pretty large percent, actually, if you look at the total. Of course, as part of these examinations and through the referral and claims and other casework, it looks at the employee retention tax credit. That's been a hot topic with the IRS. They continue to look into it and issued that moratorium back in September. Now, the deadline for 2022 claims has already passed, which was back in April. But the deadline for 2021 claims is still open until April 15th, 2025. So you still have some more time there to submit a claim if you haven't. But be aware that there are a lot of promoters out there and claims that are on the, they're on the IRS Dirty Dozen list. So be warned that there are some scams out there. So be very careful in making sure that you do qualify for this credit. If you haven't claimed it yet and are thinking about it to do it, make sure you do your due diligence. So far, the IRS has determined that more than $1 billion worth of credits were claimed incorrectly. An additional $3 billion worth of claims is being reviewed by the IRS Criminal Investigations team. Big focus area. If you filed and received your refund, just make sure you have documentation ready in case of an audit. And if you filed before September, the IRS is still processing those claims and issuing checks, but very slowed down for sure. If you filed after that date in September of last year, the IRS is putting a pause on those refund checks. The commissioner said that the pause would be lifted sometime in the spring. Well, here we are. It's almost June, so let's see when it actually does happen. There is a number you can call to see if you can kind of get a status check on your claim. However, chances are you'll be on hold for a little while, and good luck getting through. If you filed but haven't received your refund check yet, too, there is still an opportunity to withdraw the claim. So far, 1,800 entities have withdrawn about $251 million of credits. There was also a voluntary disclosure program that ended in March that returned $225 million of credits from over 500 taxpayers, and with another 800 still submissions that the IRS is processing. So the IRS may decide to reopen this program depending on whether Congress extends the statute of limitations on those claims. A lot of these examinations are also resulting from data-driven methods, which help indicate private benefits, inurement, specifically in the area related to employment taxes, unrelated business income, and unreported compensation. So a few areas where the IRS could assess taxes is really where they're focusing on. With that, on to our third polling question, Danielle.
Thank you, Emina. Poll question number 3. I have seen or received notices about A, payroll taxes, B, tax returns, C, informational returns, D, all of the above, E, some of the above, or F, none of the above?
Thank you. I'm curious to see. We've certainly seen an uptick in just random notices here and there related to different matters and different issues. So I'm curious to see what the audience is seeing as well.
All right, and we'll go ahead and move the poll forward to the results.
Okay, so hodgepodge, yeah, as expected, all of them above, some of the above, none of the above, yeah. Yeah, that's pretty much what we've expected to see is consistent with what we're seeing in practice as well. So, great. Okay. Okay, let's dive deeper a little bit into kind of compliance strategies, what they're looking at. Oops, I may have, there we go. Sorry. There we go. So some of the compliance strategies that the IRS is looking into is private foundations, endowments, 501c7 entities, which are social clubs, and non-member income. Also Form 990 filing eligibility, making sure organizations who are actually filing those Form 990 postcards are actually receiving $50,000 or less of gross receipts, and for-profit conversions and self-dealing. Self-dealing, again, is more on the private foundation side and filing requirements. So areas that they're really kind of looking into are kind of interesting. So let's look at, they're also collaborating with other organizations and other divisions within the IRS. So partnering with the large business and international division and the research, applied analytics, and statistics division, that's a mouthful, hence the acronyms, to help identify links involving high net worth individuals and tax-exempt organizations. The IRS also is continuing to work with other divisions to decrease the risk of duplicative or improper payments and fraud related to elective payments that Mike mentioned earlier with regards to the clean energy tax credits. Form 13909 can now be emailed to the IRS. Ta-da! Finally, the IRS is coming with the times. So it's great to finally see them not have to fax something or mail something, but that form is essentially used to submit a complaint about tax-exempt organizations. IRS uses that information that is provided to determine if there has been a violation of federal law. So areas, kind of a hodgepodge of areas that they're seeing issues and are focusing on. With that, as part of their compliance checks and contacts, they've written essentially letters to organizations, about 8,139 of those. Of those, they've closed so far 4,571 with a 77.5% change rate. Specifically, these changes were related to failure to file a Form 4720 to report excise taxes under Section 4960 for compensation paid over $1 million, failure to file a Form 990T to report and pay unrelated business income tax on unrelated business income, and failure to file employment tax returns, including the Form 940 and 945. Another area of focus has been noncompliance with the Section 501R4 financial assistance policy by tax-exempt hospitals. As Mike mentioned earlier, lawmakers are currently looking at issuing possible new regulations down the road with stronger enforcement on this code section, making recommendations in specific areas, which include making financial assistance policies more accessible, reduce the complexities of actual financial assistance applications, prohibiting the billing of gross charges to patients, ban harmful collection practices such as wage garnishments or the denial of necessary care due to outstanding bills, strengthening the reasonable efforts requirements for hospitals to determine financial assistance eligibility before pursuing collections, and then increased enforcement activities such as IRS audits and revocation of tax-exempt status, even to increase accountability for non-compliant hospitals. So as Mike mentioned, kind of a big deal right now that they're looking into hospital activities. So we'll see what comes out of that. Okay. So then the IRS also issues their priority guidance plan, which addresses different areas that they're going to work on or areas that they're working on. A lot of these issues have carried over from years and years and years. You can kind of see some of them are from 2020 and even older than that, where the public has asked for some guidance and additional clarity or final regulations, proposed regulations regarding activities that have happened and transpired over the years. So as part of their IRS priority guidance plan, every year they kind of issue a list of things that they'll focus on. This one, the first one on this list, is looking at revisiting the group exemption letters. The latest and most substantial changes were proposed in Notice 2020-36, which would update and supersede the current procedures in effect. The proposed revenue procedure was issued back in May 2020 and currently remains pending with the IRS, which really leaves nonprofits questioning when these changes may become final. And at this point, the IRS is still not accepting actual requests for group exemption letters until the publication is final revenue procedures or other guidance is issued. Another area that they're working on is guidance for allocation of expenses when computing unrelated business income under the silo rules. So that's one that I'm personally kind of looking forward to see, hey, what are we, what is considered reasonable, what isn't considered reasonable. The IRS, as part of their UBI regulations that they've issued earlier this year and the siloing, have said, hey, we know we need to also focus on expenses. So maybe, just maybe this year or next year, we'll get some more guidance on that. There's also some guidance addressing changes to the cafeteria plan under Section 529, where the Secure 2.0 Act allows funds from an established 529 account to be transferred tax-free to a Roth IRA for the beneficiary of the 529 accounts. Right now, unused educational funds have the potential to kickstart a beneficiary's Roth IRA savings, so this change could come with limitations, and the IRS is working on more guidance. There's also guidance coming down the pipeline regarding private foundation investments in a partnership in which the disqualified persons are also partners. And look at that. We actually crossed off some things. The IRS did actually accomplish of issuing final regulations under 509A3, supporting organizations, which were just released last month, so in April. Yay, finally something. They also issued final regulations in October last year that prohibit certain contributions to Type 1 and Type 2 supporting organizations from persons or entities that control a supported organization of those, along with other guidance that discusses and specifics with regards to supporting organizations. So a lot of new information out there, somewhat old, but solidified a few more things for everyone. So, okay. With that, I know Mike touched base on the recent DAF requirements, and with more to come on that for sure, with a lot more hot topics, as he mentioned, with guidance on excise taxes regarding donor-advised funds, supporting organizations, and how those distributions from DAFs will affect the public support test for charities. This last bullet point, number 9, is related to churches. The IRS is working on regulations designating an appropriate high-level Treasury official under Section 7611, which is the code section where Congress has imposed special limitations on how and when the IRS may conduct civil tax inquiries and examinations of churches. So IRS has a lot on their plate and are working through a lot of things. With that, I believe our last polling question: what are you looking forward to in getting guidance on? So let's see what our audience thinks. Danielle, back to you for opening the poll, hopefully.
Great. Yeah, polls should be open, everybody. If you're unable to see the poll screen, they're within your slides, so please be sure those are open and the window is expanded. And to choose your option, please select the button right next to your answer and hit submit. If you're having trouble seeing the slide, please refresh your screen. We'll leave this up for just a few more seconds. Wonderful. And I will forward on to the results.
Thank you. Oh, yeah, expense allocations for UBI and DAF. Yep, that's what I expected as well. That's been one on their list for many, many years for sure. So hopefully we'll see something soon. All right, switching a little bit of gears, and let's wrap it up with a few more slides. Expired legislation that's coming up in 2025 as part of the Tax Cuts and Jobs Act. Quite a few are expiring, such as many of the individual income tax changes that drastically reduce the number of itemizers eligible to claim that charitable deduction. So that includes the double standard deduction, the caps on the home mortgage deduction, and the state and local tax as well. So we'll see what happens and if any of that will be extended, but more to come. It's got a little bit more to go. That also includes the doubling of the state and gift tax exemption, also expires in 2025, which will affect charitable bequests most likely. Also, the 60% increased charitable deduction limit for individuals will go back down for cash contributions to 50% for public charities. So we'll see what happens. Maybe it'll extend it, maybe it won't. But we are thinking that the extension will cost approximately $600 million per year if it does get extended. So more to come. We'll see what the election year results and where things head into. We also have the Secure Act, and just kind of a reminder that there's still a once-in-a-lifetime $50,000 tax-free distribution that's allowed from an individual retirement account, so IRAs, to split interest entities like charitable gift annuities and charitable remainder trusts, so CRTs. Also effective for tax years beginning after 12/29/22. I know those dates are always kind of weird. It's really just dependent upon whenever IRS actually publishes something, so hence the weird dates. This is also useful for donors receiving requirement minimum distribution requirements, those RMDs, before they need the income for living expenses because it actually defers taxable income. Speaking of elections, election year updates, always a hot topic and some reminders as we head into a lot more activities during the year. So just a few more minutes talk about that and requirements with regards to 501c3 organizations and hot topics of 501c4s. So 501c3 organizations, lobbying is okay for public charities, but cannot be substantial. Lobbying can help with an organization's charitable mission, especially the nonprofits that serve vulnerable communities. A lot of the times they may be the only voice to those communities that have policy discussions in the legislative process. So the organization's input is important in educating policymakers and making sure legislators enact policies that reflect and address the community's needs and concerns and find solutions. Like I mentioned, 501c organizations that are public charities, lobbying is okay as long as it's not substantial. To determine what is considered substantial, you can use either the facts and circumstances test, or you can use the lobbying threshold set under 501H once the election is made. Under the facts and circumstances test, the IRS looks at all the facts and circumstances to determine if lobbying activities are considered excessive and applies the test on a case-by-case basis. A variety of factors are considered, including volunteer efforts, time and expenses spent on lobbying when compared to the organization's overall exempt activities. Under this test, there's really no clear guidance on how much you can spend on lobbying for it to be considered excessive. So there's no expenditure level is guaranteed safe, essentially. In order to deal with that, though, with the uncertainty of the no substantial part test, Congress enacted Section 501H, which allows organizations to elect to be covered by the expenditure test and a clearer set of definitions. So in order to be covered by that expenditure test, you must make an election. So Form 5768 would have to be filed, which you can do at any time during the tax year, and it will remain in effect for the future years unless it's revoked by the organization. Now note, 501c organizations that are private foundations, you cannot do lobbying, otherwise you pay an excise tax on that. In addition, the IRS also requires that funds are restored to the private foundation for that lobbying expenditure. Otherwise, the foundation will have to pay another excise tax on top of that. Also keep in mind both public charities or private foundations cannot undertake any political activities, otherwise you're at risk of losing the tax-exempt status. Political activities refer to activities to support or oppose the election of a candidate or a party for public office. But you can have get out the vote drive or voter registration events if it's conducted in an unbiased and nonpartisan manner, which is considered advocacy. So advocacy is okay. Do note that voter registration events that promote a certain candidate or a party would be political campaign activity. So there's kind of a fine line of what's okay and what isn't okay. So definitely consult your tax advisor as to, hey, here's what we're thinking, and would this be okay or not? Organizations should also be very mindful that during election year, activities that usually would be considered advocacy, such as educating the public on a certain issue, could be considered political campaign intervention if that issue is particularly associated with a candidate or a party and is carried out close to an election, or the activity is not part of their usual advocacy communications done by the organization. So kind of watch out for those things. And then finally and lastly, the 501c3 organizations, those are social welfare organizations, are popping up a lot more, and we're seeing a lot more in practice and being utilized. Can do unlimited lobbying, provided lobbying is related to their exempt purpose. Political activities are okay too for these organizations as long as it's not significant, although IRS hasn't actually defined what significant is, so it's kind of a very gray area still, and maybe some more guidance will be issued in the future. Also keep in mind if there are political expenditures and investment income, the organization must pay the tax on Form 1120 POL on the lesser of political expenditures or the net investment income. There's also current legislation in the works looking at further at 501c4 organizations as part of the House and Ways Committee request for information. It's resulting in a lot of questioning as to how funds are being used, looking at international activities and funding for not-for-profits, including donor disclosures, foreign influence on political campaign activities, and funding to support election administration. So a lot out there, many areas being looked at, compensation, political activities, you name it. I can see in one of our audience questions, cryptocurrency too. IRS is constantly looking at that as well and trying to maneuver this new environment that we're all in. So with that, that takes us almost to the end of our presentation. Wanted to say thank you to everyone who's attended. We're going to run out of time to answer questions, so we'll be in touch with those who have reached out to us after the presentation. Danielle, back to you.
Thank you, Emina and Mike, for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us, as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Mike and Emina directly. Their contact information is in your console. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have any trouble downloading it now. Finally, here's a link to an online survey for today's presentation. Thank you for joining our webcast, and we hope you'll join us again next time.